Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Hey, we want to get to one company definitely on our radar. We're talking about Carnival. Shares were down as much as 6.5%, the most intraday since early August. The cruise line operator forecasted adjusted EBITDA for the fourth quarter of about $1.14 billion, slightly below consensus estimates of $1.15 billion. Earnings report also reflected a weaker outlook for net yields in the current quarter, although I will say analysts seem pretty upbeat about the outlook for this company. And I should say shares of Carnival right now, Tim, just down about 1.2%.
Great to have back with us Josh Weinstein, President, CEO, Chief Climate Officer of Carnival Corporation, with us from Carnival HQ down in Miami. Josh, good to have you with us this afternoon. I want to talk about the bottom line, eighth quarter of bottom line beats for you all. Investors still focusing on that slightly below consensus outlook for adjusted EBITDA. Stock not down as much now as it was earlier in the day, as Carol just mentioned. Tell us about the quarter that was, and perhaps most importantly, the outlook. What are you seeing?
Yeah, hi. Thanks for having me. I don't usually follow the Fed chairman, so this is a big thrill. Tell him to go check out Jack White. Yeah, Jack White in Nashville.
Thank you for your patience. We so appreciate it.
No, it was interesting. Well, we'll talk about the third quarter first, and as I've been able to say for the last several quarters, it's record. We just hit a record for revenues, for revenue yields, for operating income, customer deposits, bookings 2 years out. So right up and down our business, it's records and strong demand. So we ended the third quarter up about 8.7% in our yields year over year, which was strong. And at the same time, we held our costs flat, which was also good to note, and that resulted in, like I said, a record quarter. And as we were able to adjust our full year guidance, we did that for the third time this year, and it's going to take us up to about $6 billion of EBITDA, which again, to use a broken record word, it's a record. And so we're expecting much more as we get into the fourth quarter and then beyond.
You know, Jay Powell, Fed chair, obviously, that you just listened to. I am curious, Josh, if in terms of macro, what matters in terms of Fed policy for you and what's going on in terms of the interest rate environment? He did also talk about the savings rate, suggesting consumers can continue spending, which we want to get into too, in terms of, it seems like consumers are certainly still spending on cruises. But give us macro, give us consumer spending, how you would describe it all.
Well, for us, the word's going to be robust. We've been living through this cycle with everybody else. We've lived through the high inflation, we lived in the high interest rate environment, and now we see inflation down. We see the Fed taking action to start reducing that interest rate environment. And through all of it, what we've been seeing is robust demand. And because of our business, first of all, it's a global business, as you know. We have a portfolio of brands that are really world-class all over the world. And what we see is strong demand, no matter how you slice it, whether it's geographic, whether it's contemporary versus more premium. We're seeing that strength, and we see it in the results. We see it in the onboard spending levels. As part of our third quarter results, it's not just about the ticket revenue, which was taken anywhere from 6 months to up to 2 years in advance, but what's the actual onboard spending environment, which is much more real time. And the fact is our onboard spending for this past quarter was up over 6% year over year. And that's actually an acceleration, because in the second quarter it was up closer to 4% year over year. So what we're seeing is consumers that are healthy, that still want to spend on experiences. And as you've probably heard me say before, we are an unparalleled value, right? We are a better value to land. I remember being in the offices with you in December talking about my hotel stay. Not only are we unparalleled in the value, we are unparalleled in the experience that we give to people. You get value for what you pay for, and we deliver on that guest experience like nobody else.
So Josh, are you seeing any weakness across any part of the portfolio of brands right now from any segment of the consumer?
No, we're really not.
No pullback
really
whatsoever?
No, I mean, as a matter of fact, if you look at our 2025 booked position, it's higher in price and occupancy than it's ever been at the same point in time. When you look at 2025, we're higher in every single quarter on price and occupancy. So things are continuing to move in the right direction. And I think cruise is tiny. Right. At the end of the day, we're the biggest cruise company in the world. But if you take the whole cruise industry, it's only about 2% of the overall vacation market. So we are a very tiny segment in a huge market with a lot of room to grow because we're getting the word out. We are being more effective in communicating the value and communicating the experience and really differentiating our brands so that they get a cut through and it means something to people, and that's paying dividends.
Talk to us about the cost side of the equation. As you just said, and I read too, that nearly half of 2025 bookings are done at record ticket prices. The cost equation, you guys are a floating city once you're out on the water, food, meals, labor. Tell us what you're seeing in terms of the cost side of the equation, Josh.
Yeah, so it's good news there too. We are seeing that deceleration, of inflation, and we were actually just today able to take our cost guidance for the full year down from up 4.5% on a unit basis to up 3.5% on a unit basis. So we're making good progress there. We are seeing the benefit of a lot of hundreds and hundreds of activities that we're doing across our brands, taking little bits of efficiency, better sourcing savings when we can, and it adds up given our scale. So all things are starting to move in the right direction on the cost side, which is very different, obviously, than what we've been experiencing along with everybody else as we went through that inflationary cycle. Speaking
of the inflationary cycle, I'm wondering about the pricing power from your perspective. If you're going to be able to continue to raise prices, in your view, next year and year after year.
That's certainly the goal. At the beginning of this year, when we were talking about our guidance for the first time, there were a lot of folks that were saying, oh, yeah, but when you get to the fourth quarter of 2024, you took your pricing up in 2023 up 10.5%. That was our results last fourth quarter. You're not going to be able to top that. And we just came out with guidance today for the fourth quarter where our yields are going to be up 5%, the majority of which is more price. So we feel very good about what we're doing and our ability to manage the booking curve, increase our demand profile, and ultimately deliver on board as we always do.
What keeps you up at night, barring another global pandemic? No, but seriously, you've been rosy for a while, and I'm just curious. It does sound like some really strong metrics, and I said, reading some of the analyst commentary, they feel the same way. But I'm just curious, what's the difficult part of what you guys do? I mean, you're ordering new ships, you're adding to that. Tell us, Josh, where is it that you get a little concerned? Is it the election outcome? I'm just curious.
No, I think those types of things are temporal. And I mean, truthfully, after living through what we lived through in 2020 and 2021 and getting back from literally a pause to where we are today, there's really not much that keeps me up at night. Truthfully, that's within our control. I mean, at the end of the day, in a 2-year period, we went from negative EBITDA to up over $6 billion in EBITDA. So I don't see much within our control that we can't push forward, and that's showing. I mean, just in this year alone, we came out with guidance in December for the first time, and we said our yields will be up about 8.5%. Now we're saying up close to 10.5%. We said costs would be up 4.5%. Now they're going to be up 3.5%. We said our return on invested capital will be up 9%, and now we're saying no, it's 10.5%, which is a 5-point improvement year over year. So I think we're making real good decisions. We've got an amazing team all over the world with all of our world-class brands really driving the business forward. And, I just think we're just starting to scratch that potential. We are really focused on just doing the basics better and better, and it's working.
Hey, Josh, you're also Chief Climate Officer at Carnival Corporation. You mentioned things that were in your control. One thing that's not in your control is the weather, is the climate, the connection between weather and climate. The two are not the same, but the two are certainly linked. Many Americans, millions of Americans, are still cleaning up after Helene. In multiple states, it's killed more than 100 people. Many are still missing at this point. How do you think about climate change in your role? How do you think about planning for an uncertain future?
Well, first of all, our heart and our sympathy goes out to all those impacted by Helene. I mean, it is a tragedy unfolding, and we have a lot of connections to a lot of those local communities. So that's first and foremost. As far as the bigger picture goes, we understand that the world is evolving rapidly. We need to do our part, and we need to plan for the future. When it comes to doing our part, we are steadfast in our drive to reduce our own carbon footprint and do what we can to make the world a better place. We are 35% bigger today than we were in 2011. And this year, we will emit 10% less absolute greenhouse gas emissions than we did in 2011, even though we are 35% bigger today. That's because we understand the importance of doing what we can to drive that sustainability agenda. And as far as preparing for the future, that goes into all of our decision making. When we're talking about the ships that we're building, when we're talking about the destinations that we develop, how can we develop them in a way that they can deal with whatever that environmental landscape is, not 5 years from now, but 20 years from now and 30 years from now, and keep leaning into technology, keep doing our part to figure out how we can reduce our consumption every single year. That's the goal.
And I'm assuming that's incorporated into when you guys build out, whether it was Grand Turk or I'm thinking about Celebration Key, right? That opens up in summer of 2025. Just the revenue and cost impact of that debut. Tell us a little bit about the dynamics around that one.
Yeah, it is going to be pretty special. 2025, we open up in July of 2025, and then we obviously go through a ramp up phase as we learn and we figure out what works, what doesn't work, and how we tweak. And it really is going to bear fruit in a significant way in 2026 when we have 19 Carnival Cruise Line ships that are going to be reaching Celebration Key from, I think, about 10 different home ports in the United States. So not only is that going to be a boost to our ticket revenue, it's going to be a boost to the spending in the destination. And then to the point we were just talking about, the proximity to the United States is phenomenal from a fuel spend and carbon emission standpoint, because it's so close, we can go slower and shorter distances to get there. So we are very much looking forward to its introduction.
All right, great stuff as always. You're a gem for being so patient. So appreciate it, Josh. Look forward to next time. Josh Weinstein, he's the President, CEO, and Chief Climate Officer of Carnival Corporation, joining us from Carnival's headquarters in Miami.
Okay, well, from Carnival to, Harvard, because right now we got a conversation about Harvard's endowment. It's a kind of in-house hedge fund. It's been long revered, envied, and at $50.7 billion, that's as of June of last year, it remains the biggest in higher ed, but it may not be for long. A big reason why, Carol, its money managers have underperformed and lost its investing edge.
All right, so let's get to this Bloomberg exclusive. It also is today's Bloomberg Big Take. It's among the most read on the Bloomberg terminal as we speak. Let's get into it. Bloomberg News higher education finance reporter Janet Lorin. She is with us in studio. Janet, great story. First up, though, the Harvard Endowment, its place among university endowments historically. Let's just set the scene. I mean, this has been a big one, an iconic one.
Yes, it's definitely an iconic one. It's still the largest college fund in America, and it will be probably for a bit. It was built up with donations that started at the founding of Harvard, and it goes back to 1636. You think of the principle of compounding interest. They've had these gifts for hundreds of years. They've accumulated and grown. And in 1974, Harvard decided to create a separate management company called the Harvard Management Company, or HMC, that runs the endowment. They're in the Boston Fed. It's actually a few miles from campus. And really when they started thinking about how should we invest our money, it traditionally had always been stocks and bonds, and they really weren't the envy of the world at all. They were just sort of kind of plain vanilla. And later, a guy by the name of Jack Meyer decided, we have this very long-term horizon. We could invest in things that are a little bit more risky and illiquid. And they built up a staff. He hired the best managers. They had outstanding performance, and they paid them for this outstanding performance. In some years, managers were paid $25 million because, they were beating everybody.
Yeah.
And then there were some complaints that this is unseemly for a nonprofit university. And the class of '69 famously complained. And Jack Meyer ended up leaving. A lot of people left. They created their own spin-offs. And it really hasn't been the same since then.
We can't talk about Ivy League endowments without talking about Yale's endowment and the legendary David Swensen, who died back in 2021. Talk a little bit about the differences between the Yale endowment and the Harvard endowment, and why you illustrate that in the piece.
So Harvard hired their own staff, and the more than 200 traders worked there, and they did amazing. They were amazing investors. And Yale, David Swensen came around in '86. Jack came in 1990. And David Swensen had a different model. They didn't have hundreds of employees. They had a small number of employees, but they farmed their money out to outside managers. And they were paying those fees. You've heard the famous 2 and 20. But they weren't paying them to their staff. And they built these long relationships with outside investment firms. And they seeded some of them. And as you know, private equity takes a long time to make money. You're not going to put money in a fund and expect a huge return next year. There's this thing called the J curve, where you're not going to be making money for years and years. And then, LinkedIn, Yale had this famous LinkedIn investment where they put in $8 million and they earned like $84 million, but it takes time. And while Yale was doing their thing, Harvard was doing their thing, and Harvard changed their model. And now, in some ways, they've adopted what Yale and Princeton and MIT did for years and years and years before, and they're kind of playing catch up. And now they've increased their allocation to private equity. It was 16% around 2017. Today, in the most recent report, 39%. We know it's not a great time to be expecting returns from private equity.
Right.
So. And at the same time, Harvard decreased their allocation to to public equities.
So we just got about 45 seconds left here. So, I mean, is it a case of, because you contrast what happened at Yale, that David Swensen was there for such a long time, Harvard had a lot of different managers popping in and out. I mean, what's our net takeaway, or like what happens next now?
Well,
what are you watching for?
We're waiting for their returns when they come out in a few weeks, and we'll see. I mean, they're very dependent on the endowment. About 37% of their budget comes from the endowment. And we're expecting, potentially lower fundraising this year.
Yeah, it's pretty fascinating. I feel like all of the the finances really of universities right now on everybody's radar in a big way. We didn't even get into the role of politics because
and how much it costs to go there. Factor.
Carol, yeah, well, that's what kind of blows my mind when it's almost 40% of the endowment is for the budget, and yet costs in terms of tuition keep going up and up and up. So it's just, the math on all of this is kind of mind-blowing. Janet Lorin, killer story again, higher education finance reporter at Bloomberg News. As we said, it's the Bloomberg Big Take. It's among our most read on the Bloomberg terminal on this Monday. It's also a Bloomberg exclusive.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I think I could say this every day.
What?
Lots going on in the world of AI.
Yeah, just a little bit.
I think it's fair to say. SoftBank's Vision Fund planning to invest $500 million in OpenAI. This is part of a larger funding round. This is according to the information, citing a person familiar with the deal. That's part of a raise of $6.5 billion. It would value OpenAI at $150 billion, Bloomberg previously reported. Also, California Governor Gavin Newsom has vetoed what would have become one of the most comprehensive policies governing the safety of AI in the U.S. For all things AI and technology, we turn to Max Chafkin.
It's his middle name, Max AI Chafkin.
He is, really. He knows it all. He's Bloomberg Businessweek columnist. He's also a contributor to the Elon Inc. podcast. He's the author of The Contrarian, Peter Thiel, and Silicon Valley's Pursuit of Power. He's here in the Bloomberg Interactive Brokers studio. I'll go back to Carol's comment on our planning call a little earlier today. When our producer Paul said $6.5 billion. She said, what? $6.5 billion?
That's a big cap raise.
We're not talking about a valuation. We're talking about actual cash that they're going to be using.
Yeah. That's the money that they are trying to raise, and they need it. And that is what is so interesting about both about this business and about the field in general. This isn't a situation where OpenAI, part of the situation is investors really want in on this company, but this is a company that is burning huge amounts of cash to run ChatGPT and to create the models that they are, that will be in their mind the next generation models. So the company really needs money. And quickly, frankly, because these the servers and the chips that these things run on are so expensive and use so much power to run.
I'm laughing because I use ChatGPT for the dumbest things. Last night I was like, I opened ChatGPT. I'm like, marinade for chicken breast. Literally something I can Google, but I'm like, you know what? I'm going to do it on ChatGPT, and I'm going to cost them money.
Well, and we don't know the exact numbers.
It sent me something back.
At least I don't off the top of my head, but it's definitely a much more expensive search on ChatGPT than it is on Google. So like that,
Sorry,
the decision to do that is, if you're doing it regularly, like you are probably not a moneymaker for OpenAI. And there are many people in this position. Now the plan is basically twofold. Find ways to do what they're doing cheaper and get people to pay more. So right now, ChatGPT costs like $20 a month for their paid membership. I think the plan is to slowly get the price up because they need to, frankly. And the same thing is going to happen with a lot of these generative AI tools. You're going to see price increases in the coming years because with the current price of energy and the current price of GPUs, the chips that are used to train and run these models, it cannot be done profitably at the current levels.
As I'm listening, I'm like, so is there a business model that works going forward?
I think if you ask the people who are investing in this, Masayoshi Son, or Thrive Capital, which is another one of the companies that is rumored to be in on this deal, also people talking about Microsoft, NVIDIA, the people who believe in OpenAI and in this field think that you're going to get cheaper models, you're going to get cheaper chips, and you're going to get so much demand. This is going to be such a crucial part of business that people are going to pay for it. And I think that the jury is out on that to some extent. It's not clear that you're going to want to pay, like $10, $20, $30, $40 more a month for like Microsoft Word if it has generative AI features than you are now. But that is like the bull case is that it's so valuable that that's what people are doing.
Is it so valuable though?
Version.
I know. Like, is it so valuable? Like, do we yet know the payoff?
No. The bear case against all of these things is, number one, it's not clear outside of like writing spam emails, doing kind of marketing, maybe like certain kinds of very quick news story, like a handful of areas where making PowerPoint presentations of like a handful of areas where it's clearly helpful. But beyond that, it's not clear that it's super helpful or super useful. And it's also not clear that these AI companies have enough differentiation because there are lots of competitors. OpenAI can't just raise its prices. It can't just double its prices because you have Facebook essentially giving away its algorithms. You have a bunch of different players all offering very, very similar products.
Help us understand Microsoft's relationship with OpenAI because they're the company's largest investor, but they're also working on their own products that could be competitors to what OpenAI is doing.
I mean, I think Microsoft has a very big interest in OpenAI, both as the biggest investor. They have a big equity stake. They've also put a ton of money into this company already, more than $10 billion. And, if this round closes, probably more than that. But Microsoft, obviously, they need to hedge their bets. They think this is a important field. They also have like a gigantic AI research arm already. So it's not like they're going to sit still, but they are very much working closely with OpenAI. Like this is probably the most important part of their AI strategy. Are
the AI tools that you get within Microsoft's suite of products, are those built by OpenAI or powered by OpenAI, or are those separate completely?
You have to look at exactly what Microsoft says because they've at times have made it sort of hard to tell.
Okay.
My sense is that they are mostly offering products that are powered by OpenAI.
Okay. So
and importantly, they are also reselling OpenAI's technology to companies. Now, that for a while seemed like a big, important differentiator that Microsoft had, but now OpenAI is also, as I believe we and others have reported, they are also selling their sort of like corporate offering directly. So there is a sense that there's some competition, but again, these companies their fortunes are very closely tied together. I don't think they both need each other. It's not like they're going to turn into like cutthroat competitors overnight.
Max, any chance that this is just a bust when all is said and done? As we continue to figure out, I mean, I understand the uses of generative AI, but I just wonder, we focus so much on this one company. I'm just curious what you're hearing within the industry.
Yes, it definitely could be a bust. You're seeing people on Wall Street, including some sophisticated people, start to point out like some of the issues that I'm bringing up, which is that the economics just aren't there yet. Also, anytime you're in a competitive situation, a hot market with a lot of smart players, like it's never like a sure thing that the market leader, which is OpenAI at the moment, is going to be the ultimate winner. So both the market needs to prove out, and this is a competitive market with a lot of people with a lot of resources who are also playing.
The names for our audience to keep an eye on: Microsoft, Meta, Anthropic, OpenAI. Who am I missing? X, AI?
Google. Yeah, and X, frankly. And if you're looking to tell a story about what the challenges are with OpenAI, you could start with X, which is Elon Musk's thing. XAI did not exist 18 months ago,
right.
and in a very short amount of time, Elon Musk has built essentially like a credible competitor. Now, maybe there's some differences, but again, it shows you just how competitive it is, how small the moat is that these companies have.
You rock. Max Chafkin, Bloomberg Businessweek columnist. You are listening and watching Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, with the UN General Assembly in session, lots of global leaders in town, we spent a lot of time last week talking to individuals about climate change. And even with the focus on renewables and green energy, coal is still the biggest source of electricity, accounting for 35% of the world's generation in 2023 last year. That is according to the climate think tank Ember. I think we pointed this out last time we had this guest on. Great to have back with us. And this time in studio, Randall Atkins, founder, chairman, CEO, Ramaco Resources. It's a publicly held company, $604 million market cap, company that produces metallurgical coal. That's the type of coal used in steel making. And as we talked about last time, the company is exploring domestic production of rare earth elements, something we talk about a lot. Welcome back. Great to have you in studio.
Thank you. Glad to be here.
How are you?
I'm fine for a Monday.
That's kind of what we say. Hey, listen, we made a point. I want to start here just because we made a point last time of talking about the coal that is used for electrical generation, electricity generation. We talked about thermal coal. You produce metallurgical coal. So just before we get into it, remind everybody of the difference because I think it's important.
Sure. So we kind of view coal as having sort of three legs to a stool.
Right.
One is for energy, which is thermal coal. One is for steel making, which is metallurgical coal. And the third, which is kind of an emerging field, we call coal to products, or coal to critical minerals. And that's, frankly, the route that we've sort of trailblazed a bit by working on things like rare earth elements and critical minerals and use of coal to make carbon products.
What's the connection between coal and rare earths?
Well, before we were able to discover a large deposit in Wyoming, it was theoretically possible that rare earth would be contained within coal in some different types of concentrations.
Meaning you'd find a deposit of coal, inside that deposit of coal would be rare earths.
Correct. In higher concentrations than would normally be found just as a base context within the Earth's crust. The trick is with rare earths, they're everywhere. They're not, frankly, so rare. But the concentration level is what makes it commercially feasible. And we have found, frankly, higher concentrations in our coal of heavy and medium rare earths, magnetic rare earths, than have been found, according to our friends at the Department of Energy, any place outside of Western China. So that's what's the unique part about our particular deposit.
Which, talk to us about your emphasis and stress in terms of the business that you want to focus on.
Sure. Well, we've right now got our primary business, of course, metallurgical coal.
Right.
That's our bread and butter. We kind of stumbled into the rare earth business, so to speak, accidentally. But now that we have been, advised that we've got such a significant deposit, which might have, very important strategic implications, certainly for the U.S., that we have now decided to swing into that with as much emphasis as we can.
What aid do you get from the government, U.S. government, in all of this? When they sometimes look at something like this, I mean, we talk about this with semiconductors, national security. I'm just curious if you get an assist or what's the conversations on that level?
So they start at different levels. So, we originally actually found the rare earth because we provided samples to one of the Department of Energy's national labs that was trying to do an assessment for the Defense Department. And that's how we discovered we had a significant deposit. We have got various grants and partnerships with various labs of the of the Department of Energy. Actually, today we announced we've hired as our Director of Technology a gentleman who joins us from the research arm of the Defense Department called DARPA. And so we would expect as we go further and basically add more dimension to what we're doing that we very conceivably will be working with the government in a number of different capacities.
What are the rare earths that you found in the deposit, and how do you extract them from the coal? How do you separate them?
What's the cost of doing that?
Those are three great questions. So the rare earths that we found are, as I said, the heavy and medium magnetic rare earths, which have wonderful Latin names that I will probably butcher. But the other two elements that we found, which aren't really rare earths, they're critical minerals, called germanium and gallium. They're very important, frankly, for defense-related technologies, semiconductors, etc. How do you extract the rare earths from coal? That is the process that you actually engage in when you go beyond the initial throwing your hat in the air that you've actually found them. We're in the middle of that now, which is arduous because they're measured in parts per million. So it's like almost trying to find things the size of a blood cell.
Wait, so have you done it yet or no?
Done what?
Separated out the rare earth?
We have separated them out in various sizes right now, but what we're doing, we actually have engaged a company called Fluor, which is a major engineering group that also has a large critical materials group, to actually help us determine the right process to use and then prove up the economics, which we expect to have back by the end of this year. So there are all sorts of different routes that you can take depending upon not only the chemistry, but the metallurgic and the mineralogy behind the actual rare earth deposits.
Would it involve burning the coal and then what's left after the coal burns, or is there a different process? Take us back to geology class.
Sure, no, perfect idea. So it will involve some form of either combustion or paralysis of the coal, because you need to separate the rare earth from being commingled within the carbon within the coal. And how that's done on what scale depends on really where the deposits are, because we may be dealing in concentrations of rare earth which might not be huge in terms of material mass, but might be large in terms of the quantity of rare earths. So it's not like we would be creating enough coal that we power a power plant or something like that. It would be much more confined.
Two things I'm curious about. So there is a business case to be made for doing it. You guys have figured out that it's not going to cost so much that it doesn't make sense to do. So I'm curious a little bit more about that. What's also the impact on the environment?
Sure. So the business case is one that, as I said, we're developing the precise techno-economic study, or they call it a scoping study, which will be available by the end of the year.
So you're working on it.
We're working on it.
Okay.
But the interesting thing from a business standpoint, from an overall dimension, the Chinese have been trying to put anybody out of business that gets into the rare earth business. They have a monopoly. They ruthlessly fight to maintain that monopoly, and have done predatory pricing all over the world to try to drive anybody out of business.
They've boosted a lot of production. We actually have a Bloomberg opinion piece that gets into cobalt and lithium specifically.
Same idea.
Yeah, we've seen prices plunge by more than 75% because the Chinese miners have boosted production.
Sure,
so much.
and even today, actually, DARPA is putting a conference on that involves how the United States could assist in creating sort of almost a pricing index that would stabilize the rare earth market, which is clearly not happening today.
So, okay, so you're studying the cost, the business equation. You're kind of figuring it out in terms of the economic, not the environmental impact.
Sure, the environmental impact.
Sorry, I had to think too.
Sure, will be very limited. I mean, the nice thing about coal,
even if you're burning it and stuff, that's limited.
Well, here's the trick there. On rare earths, most rare earths are found in hard minerals, cobalt, lithium, uranium, etc., which are number one radioactive. So that creates issues in terms of mining it, but more importantly in terms of processing it, which is why most rare earths are shipped to China to be processed, which, needless to say, is not helpful for the United States. So by virtue of using coal as the feedstock, that in itself is much more environmentally benign. And we're not going to be burning it in sufficient quantity that would create sort of a smokestack effect, if you will. We'll be doing it almost in like a kiln type operation. And the interesting thing is a lot of the carbon that would be thrown off from the coal, we intend to try to use to make carbon products like synthetic graphite and graphene and carbon fiber precursors. These are things that we were working on with the government way before we ever got involved in the rare earth space.
What happens if the rare earths don't pan out? What happens if you can't figure out a way to make it work financially?
If the rare earths don't pan out, actually, as I said, we'll go back to what our original intent was, which was to use coal as a feedstock to make carbon products. Because the Chinese have also basically put an export stop on synthetic graphite and regular graphite. So there's a great demand for graphite right now, which is 95% of the anodes in batteries. So that's our next product, if you will, that we'll be working on in respect to that.
So what do you anticipate, Randall, that in, I don't know whether it's 12 months, whether it's 2 years, what the product mix is for your company? Because it sounds like you guys are still kind of figuring out some things. We've got about a minute or so left. So
you bet. So very shortly, we will still be, at least in terms of cash flow, dominantly a metallurgic coal company. We're actually growing. We're probably one of the few coal companies that actually, as of last year, we will double in size between now and the next, say, 3 years. That's the metallurgic side. And the rare earth side, as you said, we're sort of figuring it out as we go along. Our hope is to basically be in a position to start a demonstration facility this coming spring, and that will then prove out the economics and the techniques that we can use to then take it into a larger commercial venture. I think as soon as we start that, we'll be probably getting a lot of assistance along the way because it will have such a potentially strategic impact on the United States.
Does just forgive me, 20, 25 seconds, the election outcome, does it matter for you guys as a business, the election outcome? Who's in the White House?
I think from the standpoint of critical minerals and rare earth, it does not, because again, it has such strategic national security significance that you've seen both the Democrats and the Republicans almost in tandem try to push for more legislation encouraging development of those.
All right. Well, so appreciate getting more time with you. We were fascinated the first time around, so really great to have you in studio.
Delighted to be here.
Randall Atkins, founder, chairman, CEO of Ramaco Resources, joining us right here in studio.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
It's Bloomberg Businessweek, and Carol, can you believe it? It's that time.
Yeah,
the end of the quarter.
I am so ready to be done with
You're
Monday.
done with the quarter?
No,
You're ready to be done with the quarter?
I'm ready to be done with the quarter. Although I like the summer quarter. Yeah.
Just making sure we're really done with the quarter.
12 months a year divided
Yeah.
by 4, 3 months makes a quarter.
Let's see quarter to date for the S&P 500, up 5%.
Well done.
This quarter.
All right, let's see what our next guest has to say. Back with us is Cole Smead, CEO and portfolio manager at Smead Capital Management. Joining us from Phoenix, the Smead Value Fund, by the way, has returned 14% on average annually, putting it in the 94th percentile according to our data. Hey, how are you?
Good to see you guys. How are you?
Yeah, we're doing okay. Just kind of going from day to day, data point to data point. Tell us a little bit about flows. What are you seeing? What does it tell you about the investment environment?
Yeah, I think there's much ado about nothing for most investors is what we've seen. Most people are very much happy and comfortable in whatever they're doing already. And I think the only problem with that is if you look at two data points that really stand out to us, household ownership of stocks, as reported by the St. Louis Federal Reserve, or what they call the Fred data, it's never been higher. And the only problem with that is that bodes very poorly for forward returns. The other thing I would mention that I was just in Asia for 2 weeks visiting with investors. And when I go to Thailand and the institutional investors there own 70% of their total equities in U.S. equities, it shows, as the Fed has been reporting, that the foreign ownership of U.S. equities has never been higher as well. Those are just contrary indicators relative to history.
Why are those contraindicators?
Yeah, if you just use the household data as an example, Tim, the correlation coefficient between that ownership and the forward returns of the S&P is like negative 0.82 to negative 0.85, depending on when you're looking at the data. So it shows you it's negatively correlated. At this level of ownership, the last time we had this was 99, was anywhere near this, and it was negative 1% for 10 years, nominally. That doesn't count inflation, in that. It was negative real returns for the S&P 500. And so I find it interesting that the households are comfortable owning a lot of their equity, or owning a lot of their assets and equities, while the foreign institutions, foreign owners, you name it, are doing the same thing at the same time. How differentiated is that globally? And I would argue that's not good for global equity investors.
Interesting. Okay, so then what are you anticipating in terms of the U.S. market for the rest of the year? We talked about being in the fourth quarter here. Do you anticipate that we just kind of mark time a little bit, or what?
Yeah, whether it's marking time or we, as we always do, we go through bull markets and bear markets. Whether that's that or starting the next bear market, it's a harbinger of what's not going to be good going forward. And this is coming right at a time where people are pretty at home with the idea that, the Fed has kind of quelched inflation, at least in the interim. I was actually just having a really fun discussion with Wilbur Ross earlier today because I'm going to be interviewing him in a few weeks. And he's got a really interesting book out called Risks and Return, where, the idea being that in the old guns and butter debate, like Tim and I, Tim's brother and I went to college at Whitman College. In Whitman College economics classes, you learned about guns and butter. This is Guns and Butter 2.0, and that was some of the discussion I was having with Wilbur Ross, and it makes me very excited to read his book. But I just say that because the idea that the fiscal spending goes on and yet inflation disappears, I think that's adorable. And I don't think it's the Fed's fault. It's the politics' fault, but fiscal largesse is a thing of this era.
Okay, you mentioned Wilbur Ross. We got to talk politics, Cole, because you're in a swing state. You get a lot of ads for Harris.
I am the swing state.
Yeah, you get a lot of ads for Harris and Trump in Arizona, where you are. You also mentioned Wilbur Ross, who was United States Secretary of Commerce during the Trump administration. How are you thinking about the election in terms of investing, in terms of what you're doing with your portfolios?
Yeah, well, I think the more important short-term thing in any discussion is whether in the doubleheader today, the Mets or the Braves will lose 2 games and send my Diamondbacks to the playoffs. But that's a whole separate issue. To your point about elections, it looks very close. It looks like a dead heat. I also think locally you're going to see a lot of split ticket. So, for example, Carrie Lake against Ruben Gallego in the Senate, she looks like a sheer loser at this point. And so I think it's interesting to see in a swing state like this where you're not going to see a down the ticket vote. Really kind of chopping up to who they like as candidates. And I think it also highlights in a state like Arizona how important candidates are. If you have bad candidates, you will lose elections. And I think both parties are losing that, figuring that out across states. So I think Arizona is a pretty good petri dish for what's going on in the country, which is we look like we have a dead heat right now. And, if you ask me who's going to win, I don't know. I just do know that fiscal spending will be the priority of either candidate, which, again, I think flows back to the idea of guns and butter 2.0. It's here to stay.
All right, let's talk about some names that you like. Top holdings, I'm looking at your value fund. Energy names are certainly there. You like Occidental. You continue to like it. Also, another one is Synovos Energy.
Yeah. Yeah, the returns on capital we're getting in the space are very attractive. And, as we all know, it's a cyclical business, so it moves around with the commodity. But the positive is price regulates supply. And so as price has gone down, you're going to see less reinvestment in the space. And what I like about it is people build up their ideas of what's going on based on what goes on in markets. And I always tell people, they say, well, what's the price of oil telling us about the future? And pardon my cruelty with this, but the answer is nothing, you idiot. It just tells us about where buyers and sellers are meeting today. And so I think there's been a lot of discussion around weak China in the last month, followed by immediately this idea that was posed in the FT that the Saudis would be, leaving the idea of $100 a barrel oil. I think that's completely hearsay, but we like the returns on the business. We like how depressed the multiples are. here at this juncture on book multiples, not even looking at free cash. And that's so far away from what people are paying for other stocks, particularly big cap tech and the S&P. It's a different game.
Yeah.
But again, go back to the other eras of guns and butter, like the 70s. You made double digit in energy and the S&P lost real money. It's a different world. And I don't think people are really thinking about the risks present. There's a lot of risk. That's what the equity investors are missing.
Hey, listen, just got about 45 seconds left here. You kicked it off saying I'm just back from Asia. What was the story around, I guess, Asia generally, but more specifically about China, especially coming off of all the stimulus? And forgive me, because it's just about 30 seconds here.
Yeah, they don't have any clue what's going on there more than anybody else in the United States does. They ask me, as the kid from Seattle, Washington, whether the Hong Kong stocks have bottomed. That's bizarre. Here's what I will say. I think people are really missing out on what can go on below the surface of the S&P, or go watch UniCredit's deal. They're going to close on Commerce Bank, and no one cares, and money's being made in Europe and banking. And so I think there's just great things to go out and make money picking stocks on. It's below the surface. It's not in the index.
New money coming in, money going out, 10 seconds. Are you seeing more money come in or people cashing out right now?
Yeah, but money's going to raise, because as long as you're doing what's differentiated, you can go raise capital, and that's what we're continuing to see. If you do what the old value people did, you're not going to raise any money.
All right, going to leave it there. Hey, Cole, good to check in with you. Cole Smead, CEO Portfolio Manager at Smead Capital Management, joining us from Phoenix.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.